Okay, so in this video, I wanted to explain risk versus reward. I think this is one of the most important things that you need to understand when it comes to investing, especially if you're a starter. Most starters that get into the investment world, they typically take on bigger risk than they should. And I always have a rule to use no more than 10% of your entire portfolio on one position. And then with this lesson, I'm going to go in a little bit more detail, and I'm also going to show you the proven facts about the market, how it gives an equal, almost like an equal balance, where less risk, less reward, more risk, more reward. So let's just forget what you think you know. That's one of the most important things when it comes to learning, is literally just drop everything. What you think that you know, you probably don't. So whether you believe it or not, the market trade-off for risk versus reward is 100%. True and statistical, proven over and over. It is. So this is a cornerstone within the financial economics. Plain and simple. Delta is the change of price in an option if the direction of the move is $1 up or down within an underlying stock. Now, I want you to go back. If you haven't ever looked at this, then you're probably not going to understand quite what the delta is. But this is something I did teach in one of my courses, and also it's mentioned in numerous times in my ebooks. And this is the delta, okay? This is going to reflect on the risk and the reward, and also the probability of being in the money or out of the money, and I'm going to show you that. So calls have a positive delta between 0 and 1. Puts have negative delta between 0 and -1. Delta is also very close to the probability of success. Example, if delta is 40, then the probability of being in the money will be close to 40% or 60% out of the money. Wow. So you're telling me that within an investment world, I actually get the statistics or the probability of successes within knowing whether or not I can make money or not. Yes, you do. So this also means if delta is 40, then the price of the option will move or decrease by 40. So remember, I said risk versus reward is 100%. So what that means is if we're making $40, then there's a chance that it will move 40%, and vice versa. If we're going to lose $40, then the probability of that moving or staying out of the money is 60%, if that makes sense. So remember though, one option contract is always 100 shares equivalent. So therefore we have the 40 cents, or 0.40 equals the $40. So there's a lot within this one slide, but the takeaway is always remember, where there's the least amount of risk, you have the greater chances of success. And then where there's greater risk, there's always greater reward. So let's take a look at the delta comparison with the probability of in the money. As I mentioned, this is one of the things that I like to show because it condenses or takes away all these columns that you need in your TD or TD Ameritrade or your Thinkorswim platform. Is if you have delta, gamma, theta, vega, and rho, and there's a few others that I put in there, I can take away the probability in the money and probability out of the money columns, because I know if I'm looking at it, for instance, at this picture, a 38 delta or a 21 delta, my percentage of being in the money and percentage out of the money is just that. You have 38% probability in the money, meaning that that strike price has a 30% chance of being met before this expiration date, which up here is November 19th, or November 19th, which would have been 4 days when I screenshotted this. Or a probability of being out of the money is 61.92%. And then also the delta of 21, you have 20% and 79% of being out of the money. Now look at the amounts in the bid and the ask columns, okay? So as I said, where there's more risk, there's more reward, and vice versa. If there's least risk, there's less reward. We have these bid and ask being totally almost 50% cheaper to one another. So a 38 delta has a 32.75 or 34.25 bid and ask, meaning that that's 100 times the 32, okay? And then also the 1300, well, the 13.25, 1300, and 14.50 being way farther down and less likely to be met at that strike price and a lot cheaper. So let's take a further look at Under Armour. Will show us that the deltas go lower the farther out of the money for both call and put sides. Wow. The farther away from the expiration date, we can also understand that delta is more. As we get closer to expiration, the deltas become less in value due to the theta or time decay. Now, let's just ignore that section because this presentation right here is more about risk versus reward. So we'll ignore the theta or time decay area. That's discussed in all my other lessons or ebooks and courses, yada, yada, yada. So the farther away that the deltas go, right, we can understand that the delta is more. Or can we say deeper in the money? So there's that 100%, right? For example, in the Under Armour, it's trading at 1733. And at the 5 and 7.5, we have deltas of 1. That means for every point up or down, that value of that option will lose 1 or $100. But it's also guaranteed that it will do that because obviously it has to move away from 5 or 7. Now, I hope that makes sense. We have probably a 100% chance within 60 days at January 17 to staying above 5 or 7.5%. Now we also can look over in the far right hand side. Over here, we have a 40.24% of being plus or minus 2. That means there's a 40% chance that Under Armour will go plus or minus 2. Well, that's not even close to being 5 and 7.5. So that's why the delta, the statistical, it literally gives us statistics of being 5 and 7.5. Same thing with the put side. There's almost a 0% chance of being down to 5 or 7.5. So therefore, those options are really meaningless. You could trade them. Of course, there's only 0 and 3 cents there. But there's a 0, I mean, it's literally giving us 0 and then 0.01% chance. So, again, risk versus reward. That's anything we do in life. So, investors use the risk-return trade-off as one of the essential components of each investment decision as well as to assess their portfolios as a whole. At the portfolio level, the risk-return trade-off can include assessments of the concentration or the diversity of holdings and whether the mix presents too much risk or a lower than desired potential for returns. And this is right from Investopedia. So here's some key takeaways. The risk-return trade-off is an investment principle that indicates that the higher the risk, the higher the potential reward. To calculate an appropriate risk-to-return trade-off, investors must consider many factors, including overall risk tolerance, the potential to replace lost funds, and more. Now, investors consider the risk-return trade-off on individual investments and across portfolios when making investment decisions. Again, that's straight from Investopedia. I wanted to highlight this so you can keep that in the back of your mind when you're making these investments or trades. So, a couple of tips that I come up with. Risky investments along with conservative investments often balance a portfolio. This doesn't apply to single investment opportunities, as this can limit or have an investor miss an opportunity. But I don't want you to go looking for the next gold mine that's going to blow up and become a $400,000 profit, because it is a lot harder than what you think. Startup investors often have too much risk because of huge investment appetites. Risk to reward does vary company to company. So, here's the 5 critical factors that determine risk to reward. We have founders, explosive markets, early revenue growth, scaling, defense, and competition. Now, all of these are pretty much common sense, but I want you to take a look at this. You can pause this video. We have the founders, explosive markets, early revenue growth, scaling, defense, and competition. Now, I do want to read this one to you because I think this is one of the most important areas where when you get into investing, you see some of these companies blowing up and then all of a sudden they start riding the tide and they just become flat. So this is early revenue growth. Sometimes early growth is often looked at as profitable and going to be great. This may be a false positive. It is generally about taking risk off the table than it is upside potential. Founders can talk founders will talk and market their game or their company so much it will have you as a startup investor tricked out. So until the product is sold, then it means nothing. The question is, how fast can sales grow? Remember, taking risk off the table is usually the first thing company founders focus on. Again, taking risk off the table is what they focus on. They don't care about growth, the competitiveness of the market, or anything. They're basically weeding out that risk factor for the sole sake of themselves, and that's sometimes or often the wrong mentality when it comes to owning a business. So the last and final things that I want to mention to you, and let's back up to that one thing that I said. Some companies focus on growth and upside potential. Some companies focus on reducing risk, and guess what? The best companies focus on both.